Hi guys, good evening, and sorry for the slight delay. I was busy making some notes elsewhere and I missed the fact that 6 o'clock had just arrived. How is everybody this evening? I know they say it's always, everybody always talks about the weather, but that's really, I'm sure you're as cold as I am. I don't know where you guys are. But here in Nelson Mandela Bay, it's really cold. I see my computer says it's 9 degrees. And I think here in the Eastern Cape, we're the same as Californians. If the temperature gets below 20 degrees, then we're like freezing cold. I'm just checking to see if anybody else is still joining us. Usually we have one or two that pop in just after 6. But then let's begin. Okay, so very welcome guys to our second collab of the semester 2. I hope you have managed to, if you weren't here, Amita, I know you were here last week. Darian, I don't remember seeing your name here last week, so welcome to you. And I hope you managed to listen to the recording from last week. Very, very important, guys. Even if the recordings aren't very long, so try and find some moments in your week if you haven't been able to attend the live class, which I know is difficult because it's at a very specific time. Just find that small little corner in your week for listening to the recording, because the recordings will take us through the learning units that we're going to work through for this for the course for this semester. So each recording will be like a little tiny mini lesson on part of the learning unit. Okay, and it will just kind of guide you as to where you should be and what you should be doing next, what your homework is, and it's just to keep you working through the module. It's to kind of also motivate you to keep working through the module as we go along. So I hope you did. So if you did listen to the recording or you were here last week, you know that for your homework, I asked you guys to read through Learning Unit 1. It's a very short little chapter, but the first part of it, there is quite a bit of, well, really most of the chapter, there is quite a lot of theory. So what I wanted you to do, and I explained the learning objectives last week, was that you were to read through your Learning Unit 1, and you can do this for homework this week if you didn't do it last week, because this week we're still working on Learning Unit 1. Read through the learning unit, and then as you come to each of these sections where you identify, okay, this is the section in my textbook that covers this particular learning objective, just in pencil or whatever next to that heading, you write there LU1 or LU2 or LU3, so that when you're doing your revision with your textbook, you will quickly be able to identify where the learning objectives are in the textbook, which tells you, remember I said the learning objectives are your assessment brief. That is what they ask you. They're telling us up front, this is what we want you to know by the end of this module, and this is what we'll be testing you on. So we can concentrate our revision on these exact points and then know we'll be prepared for our assessments. Okay, so hopefully you did that. Just very quickly, if you have you guys got your textbooks with you? You can just put a thumbs up. You can, casual guys, not formal, you can chat. You can open your microphone. You're welcome to chat to each other in the chat box on the side, or ask me questions or whatever. Okay, so I know it's easier for you guys to do that, so don't be shy. Okay, so if you've got your textbooks, I'm just quickly going to give you the page numbers in your textbooks for each of these learning objectives so that you know you are where you're supposed to be. And then if you haven't done your reading, you can focus your reading when you do go back through it. So if you start at the beginning of the chapter, page 2, introduction, the second paragraph on page 2 begins, the term finance describes the study, creation and management of money. So that is LO1. So next to that paragraph in your left margin, you can write LO1, define finance. Okay, so that's where you find that definition. Then our LO2, identify the primary activities of the financial manager. At the bottom of page 2, section 1.2, the primary activities of the financial manager. Next to that heading, you can write LO2. That's where that section starts. Then that carries on till the end of question 1.1. So that takes us to page 4. And we have got on page 4, section 1.3, wealth maximization as the key objective of a business. So next to that paragraph, you can write LO3, or should I say next to that section 1.3 is learning objective 3. Sorry, guys, I don't know if I mentioned LO stands for learning objective. So it's the same thing as a learning outcome, which you guys would have used that language in school. So learning objective or learning outcome. So LO3 is basically page 4. Then on page 5, we've got economic value added, EVA. That is LO6, 1.3.1. And then EVA, the explanation and example 1.1 through to the end of that, all of that is LO6. And that's what we're going to look at tonight, is this EVA, this section. So we'll be coming back to that. Then if you page over to page 11, section 1.4, the relationship between financial institutions and markets. Next to that, you can write LO4. Explain the relationship between financial institutions and markets. So also with each of these learning objectives, if you look at the action word, this says define, this says identify, this says explain, discuss. That means that all of those points there, you'll have to prepare some kind of short little paragraph question. You'll have to memorize what the primary activities are and be able to give a short description or examples of each. The same with explain wealth maximization. You must prepare so that you are able to write a short paragraph comparing wealth maximization to profit maximization, etc. Okay. Because there's many ways they can word a question if that is the content that we are going to learn. But if you know the content, it doesn't matter how they word the question, you'll be able to write a short paragraph, give a definition, discuss, compare, or whatever it happens to be. So then we go over the page to page 13. And section 1.4.3, next to that you can write LO5, financial markets, and below that capital markets, and below that money markets. LO5 says discuss the role and operations of the money market and the capital market. So that is section 1.4.3. Financial markets are our money markets and our capital markets. That's LO5. And that is then takes us through to the end of the chapter, where we've got all these questions at the end of the chapter which you can use for revision. So you should try and work through as many of these questions at the end of the chapter as possible, just to test yourselves. Did I understand it? Can I write a little paragraph? Can I, like question 1.3 says, discuss? Question 1.4 is also, you've got to identify and write little paragraphs, etc. Question 1.5 will give us practice in learning objective 6, calculating the economic value added of an entity. And that's quite a nice question, because the first part of that question says discuss the concept of EVA. So we first need to prove that we know what it is we're calculating when we calculate economic value added. And then in part 2, calculate the EVA. So question 1.5 for this evening's, what we're going to cover the work we're going to cover this evening, that's a very important revision question. Very important revision question, okay, for EVA. And then in the revision questions that begin on page 17, those are always very important. We've got revision question 1, which is a nice long question, multiple choice, that will test you on all of the content of Learning Unit 1. So go through that, and that will help you to see what you've understood, what you've remembered, and what you still need to go back and revise. Okay, very simple chapter. It's short and sweet, but there is quite a lot of theory in it. But we've got our learning objectives that we can work within to guide us exactly what we've got to do with this theory in the chapter. Okay, so any questions on that so far? That should then set you up for mastering Learning Unit 1, and then next week we're going to go on to Learning Unit 2, Risk and Return, in our collab class next Wednesday. Okay. All right, so now, as I said, we want to look at EVA. So go to page 5 in your textbooks. And has anyone got anything you want to ask me? What's come up in your minds that you want to that you weren't sure about as we were chatting? Anything? And you can ask me anything, guys. And remember also, you don't have to wait until we have a collab. You can send me an email anytime you've got a question during the week. And I'll happily help you if I'm able to, or otherwise I'll guide you in the right direction if I don't know the answer to what you've asked. Okay, sorry, I'm just quickly making a note here. All right, so EVA, economic value added. So what is economic value added? Can either of you give me an explanation? Have you had a look at this? Would you like to have a bash at how we explain what EVA is, economic value added? What is your, okay. No one's got your perception of what economic value added is. Okay, so remember, we are doing financial management in this course, not financial accounting. So financial accounting works according to very strict rules of what we have to do with different amounts, whether we can recognize the amount, whether we have to expense it, whether we're allowed to capitalize it. Lots of different rules according to IFRS. So as managers of a business, sometimes we want to look at the information, financial information of a business in a slightly different way that's going to give us the information in a way that's going to be useful to us to make decisions and to also analyze what's happened. So economic value added is one of these calculations. So I can't remember where this is in the textbook here, but EVA is actually a copyrighted calculation, if you want to call it that, concept that was devised by a management consultant company, and they devised this way of re-looking at a company's profit to give management some useful information about the profit. So what we want to know in economic value added, so remember, one of our very important, and you would have come across this in second year as well, learning objectives is that the financial managers are always concerned with wealth maximization rather than profit maximization. So this is exactly what EVA helps us to calculate. Our income statement, normal consolidated statement of profit or loss, tells us about our profit maximization according to IFRS rules. We want to know this particular year, did we grow the wealth of the shareholders? So we are going to take our financial statements and just rework them a little bit to give us this particular answer. By how much did the wealth of the shareholders grow in this particular year? So that's where the term economic value added. The value added means, did we grow the wealth? Did we add to the wealth of the shareholders? And economic means in economic terms, in rands and cents terms, did we add to the value, the wealth of the shareholders? So that's where all of this arises. So if you look at the bottom of page 5, we've just got it's a very short little formula that they came up with. So EVA, economic value added, is equal to NOPAT, N-O-P-A-T, and that just stands for net operating profit after tax. So that's a simple figure for us to calculate. But again, here we're going to use very specific, take a specific approach, because it's going to be according to this EVA exercise. So net operating profit after tax, if from that we subtract the rand value of, we're going to take our invested capital. So invested capital means the capital structure of the company, what long-term financing is the company employing in their business. Okay, so all long-term financing multiplied by our WACC percentage, which is our weighted average cost of capital. So that part in brackets, invested capital times WACC. Invested capital is a rand value, the total rand value that the company has got invested in sources of finance. And we are going to multiply that by the weighted average cost of capital, our cost of capital percentage. So our cost of capital percentage is going to tell us what rand value did it cost us to have access to this capital in this particular year. Invested capital times the cost of capital percentage tells us what was the rand value of our access to that cost, to that capital in the year. And that rand value, in other words, it's basically kind of like an interest cost. It's like what rand value did we have to pay in interest and dividends and returns to our shareholders. And we are going to then subtract that rand value from the net operating profit after tax. If NOPAT minus cost of capital leaves us with a positive figure, in other words, there is still some profit left over, then we have added to the value of the company. There is some economic value added. If we take NOPAT minus the cost of capital and we end up with a negative figure, then it cost us more to gain access to that capital than we actually earned in profits in that particular year. So that is simply telling us, did we add to shareholder wealth, or did shareholder wealth decline during the year? So that's the EVA formula. NOPAT, net operating profit after tax. There's a little formula as to how we calculate that, because we're going to take accounting profit after tax and we're going to make some adjustments to that to arrive at our management accounting NOPAT figure. And then we're going to do a second calculation to calculate what is our total invested capital rand value. And then we can then multiply that by the WACC percentage to arrive at that so-called interest cost. And then we can say NOPAT minus the cost of capital equals EVA. So that's what the EVA calculation is all about and why we are doing it. So we haven't got time in this class to go through the whole of example 1, but what I want to direct your attention to, you must go to from page 5, you must read through all of this, read through it slowly so that you understand it as we're going along. Because it explains in different terms to what I've already explained to you. When on page 6, there are some important, and I should call them rules for calculating NOPAT. And this is the important part where you've got these 4 bullet points on page 6. Just above that, it says NOPAT represents the net profit after tax that has been derived from the entity's operations. So it's basically operational profit before charging any interest. And financing costs, accounting depreciation and or amortization, non-cash accounting entries, and discretionary investment expenditures, those are the 4 bullet points that you will have to apply in any EVA question that they give you in a test or in an exam. Financing costs, that just means interest. We know financing costs means what return did I have to pay to whoever provided me with some financing. Non-cash accounting entries, you've come across that already in your relevant cost sections in second year finance. So just go over that section again if you've forgotten what all the different non-cash accounting type entries are. Okay, so for example, credit losses. And then discretionary investment expenditures. This is, we call it an investment expenditure, so that means it's a large amount that the company spent during the year. For example, on a big marketing campaign, they're doing a big research and development project, they are implementing some big new system, and so they spent a huge amount on retraining staff. You can kind of think of it as project-based, large projects, large costly projects that we expect to derive benefit from over the future years, the future 2 or 3 or 4 or 5 years. But we spent the money in the current financial year. So with this discretionary investment expenditure, according to IFRS rules, we are not allowed to, although we will derive benefit from that spending over the next 2 or 3 or 4 or 5 years, according to IFRS rules, we're not allowed to capitalize that amount. We have to expense it in the year in which we spent the money. If you guys have done, which I'm sure you've done accounting too, you would have come across those rules in what's that section called, intangible assets. Okay, so you know the rules for intangible assets. There's only certain circumstances where we are allowed to capitalize that money spent on a so-called intangible asset, and in a lot of the circumstances, we are forced by IFRS rules to expense them. So that's what that discretionary bullet point is all about. So read through all of that in detail. Make sure you understand it all. On page 7, they've got a little formula for calculating WACC. You can ignore that. You will always be given the WACC percentage. You'll never have to calculate it. Except, yeah, you won't have to calculate it using this formula. Let me put it that way. And then if you go over the page to example 1.1, once you've read through that whole section on EVA and you've understood it all, then work your way step by step through example 1.1. because that will really then indicate to you, here is a case study. We've got financial information for a particular company. They've given us the financial results for 2 years. They usually, in these questions, we work with 2 years worth of information at least. And then in the table on page 9, they have taken you step by step through the calculation of NOPAT, net operating profit after tax. And then over the page on page 10, we do the second calculation, where we've got to calculate the rand value of our invested capital for the year. And then once we've got those two amounts, we can calculate our EVA, NOPAT minus invested capital times WACC. Just a look in this question. I'm just looking quickly to see where they gave us the WACC percentage in this question, so I can show you where they told us. Oh, there we go. On the table on page 8, there's a little table of information at the bottom of page 8, and there's a line in that table that says the company's WACC for both 2002 and 2003 was 10%. So that will always be given to you. So there's in our little formula, we've got 3 figures that we have to have. We've got to work out NOPAT. We've got to know what our invested capital is, and we've got to know what the WACC is. And once we've got those 3 figures, we can calculate the EVA, the economic value added, using our little formula. Okay. So this example is an excellent example, and if you work your way through that, it can feel a bit tricky in the beginning, but just get used to the rules of what to do. Follow exactly what they did with each amount. In which year did we add an amount back? In which year did we subtract an amount? So that you get used to working with this. And just one important point while we're looking at example 1.1. NOPAT, net operating profit after tax. So we want an after-tax figure. So if you look at the table on page 9, please just put a little star next to the second line in that table where it says add back the interest expense. And you'll see that we add back the interest expense that was given to us in the information, but we add back the after-tax interest expense. So just for that interest expense, when we add it back, we want it must be after tax. So just make a note of that. When we add back research and development or those discretionary costs, it's always the full amount. If we add back non-cash expenditure, it's always just whatever the full amount is that they gave us. It's only when we add back interest that we must calculate the after-tax value of the interest and add that back. Okay, so let's go and have a look at a simple example. Oh, yeah, that one is a question that we did last week. Okay, so here on the screen, just zoom in if your screen is a bit small. Hopefully you can then read that nicely. This is the information that we have been given. This is a question 1 from a previous test or an exam. I can't remember exactly where it came from. And it's for 15 marks, which remember you will only have 15 minutes in which to complete this question. So they have given us the following information related to Raiders Limited for the year ending 31 July 2016. So in this question, we've just got 1 year's worth of information. And this is for the year 2016. So from our income statement, they have given us our revenue figure Remember, revenue figure is the very first, the top line on the income statement. And they have given us our profit before tax figure from our income statement. So the reason that they've given us two amounts here is, again, they are testing the students to check that when you calculate NOPAT, you know which figure from the income statement that you must begin your calculation with. So they've given us revenue and profit before tax. Then from the statement of financial position, they have given us our equity balance for the year ended 2016, and interest-bearing bank loans, which is our second source of finance, they've put a question mark there. So in other words, we're going to have to calculate what that missing amount is using our EVA formula. Remember, if you've got any formula or any calculation, as long as you have got all other variables in that particular formula, you are always then able to calculate the one missing variable. And it doesn't matter which variable in the formula is missing, as long as you've got all the other variables, you can calculate the missing variable. So in this instance, in our EVA calculation, EVA equals NOPAT minus invested capital times WACC. The missing figure is going to be what is the rand value of the interest-bearing bank loans, which forms part of our invested capital. Because remember, our invested capital are all formats of long-term financing. So then the additional information they've given us is the company's weighted average cost of capital is 8.75. So that's our WACC. We now know what that is. Sorry, I don't. When I'm working here, I don't have a highlighter, so that's why I like to work in the PDF, but at least when I'm working here, I can see the chat box at the same time. Okay, so that's our WACC, important. We're going to highlight that. Corporate tax rate of 28% applies for this question. Always take note. Sometimes these days it could be 28, and some questions they've already updated that to the new rate of 27%. And then it says included within the profit, profit before taxation, included in the calculation of that profit, we have got depreciation of 65,000 Rand. And in this particular year, accounting depreciation and wear and tear for tax purposes were both 65,000 Rand. We had an interest expense of 27,500 in our income statement in deriving that particular profit. So remember, we would have deducted the interest before we got to the profit before tax. And then other non-cash expenses, including in our income statement, was 45,000 Rand. Required, if the economic value added has been calculated as 233,950 Rand, calculate the amount of interest-bearing bank loans as at the 31st of July 2016. Okay. So have a look at that info. And then I'm going to go to the next page, which is the memo for this question. And I'll show you how we would then do this calculation. So remember, we've just got those three figures in our formula. The EVA, the NOPAT, and I'll call it 4. If I'm including the EVA answer, it's 4. It's EVA, it's NOPAT, it's the total Rand value of the invested capital, and it's the WACC percentage. Okay, so that's all that we've got to identify, be able to calculate. So here, let me just enlarge this a bit. Okay. So remember, our first step is to calculate NOPAT, net operating profit after tax. So our rules for calculating NOPAT state that we're going to draw up a little table to calculate NOPAT, and our first line in our table is going to be the rand value of the profit after tax. So in the info they gave us, they said we had 320,000 rand profit before tax. So also your layout for this could be different. You could have started a top line here that said profit before tax, 320,000. Your next line below would say less tax at 28%, minus 89,600. And then the third row after that would have said profit after tax, 230,400. In this case, they just did the calculation in brackets here, all on the same line. However you prefer to do it, but remember, in financial management, management accounting, we always detail our workings and label it, describe it, write down units of measure, explain what we are doing in each step as we write it down on our answer sheet. We never just write down a whole page full of numbers. So we always use tables like this with a description for each row, putting our calculations in brackets so that anybody that looks at this afterwards is able to follow exactly what we did. They can read our descriptions, they can follow our logic, and they can therefore check what we did and understand what that calculation is telling us. That's very important in management accounting, which is basically what we're doing here. Okay, so that's our first step, because remember the NOPAT, if you go back to your description of NOPAT, it says NOPAT must be profit as net operating profit after tax. Then in those 4 bullet points, if you go, remember those 4 bullet points on page 6. If you look at our first bullet point, it said on page 6, it says financing costs. The after-tax financing costs should be added back to the accounting profit, as these are already considered in the determination of WACC. I'll explain that when we get to the WACC calculation. So we want our profit figure before deducting interest. So we want what is our profit figure for the year after tax, but before we deducted any interest. So they told us that our interest that we deducted during this year was 27,500. We want the after-tax value of the interest. So in other words, we want 72% of the 27,500, i.e. 27,500 minus the 28% tax. So that is 19,800, and we're going to add that back to our profit. In other words, I want to know what would my profit have been if I did not have that interest expense. So I'm adding back the interest. So profit after tax, add back my interest cost for the year after tax. And then if you look at the third bullet point on page 6, it says non-cash accounting entries, for example, credit losses. I'm trying to think quickly of any others. Profit or loss on sale of assets, that type of thing, non-cash expenses. We add those back as well, because we want net operating profit after tax from a cash flow point of view. Relevant, remember your relevant costs. So in this case, we want relevant income. And we are considering non-cash expenses to be irrelevant for this exercise. So they told us that in this year we spent 45,000 Rand on non-cash expenses. So we're going to add that back to our profit as well. We want to know what would my profit have been if I did not have to account according to IFRS for non-cash expenses and account for any interest payments that I made during the year. So take note, it's only the interest that we take after tax. The non-cash expenses, we just add back plonk as the full amount as it is. If they had have given us any accounting depreciation, or in this case, let's just go back to this page. I think they did. They told us that we did have depreciation for this year with 65,000, but that both accounting depreciation and wear and tear expense for tax purposes, they were both 65,000. Because so for our exercise here, we then don't have to make any adjustments to NOPAT for depreciation. But what you can also do is just get back into the habit, because in some questions they might give you a depreciation and amortization that are two different amounts. So what we would do in that case is, to our profit after tax, we would add back the accounting depreciation that we had recorded in our income statement, and we would deduct whatever the wear and tear tax allowance is, if they're different. So let's say our accounting depreciation was 65,000 and our wear and tear allowance for the year was 80,000. Then in this instance, in this table, we would have had a line that said add back accounting depreciation, and it would have been plus 65,000. Below that, we would have said less wear and tear allowance for the year, and we would have had minus 80,000. And that we would then have arrived at NOPAT. Okay, so just make sure those 4 bullet points on page 6, those are the important actions that you need to apply in transferring your accounting profit after tax into our management accounting NOPAT figure. Okay. Any questions with what we've done up to that point? Hopefully my explanations are clear enough. I'm trying to not take too long over the explanations, but I'm trying to keep them as clear as possible as well, so that you guys can follow. And remember, you've got this recording. You'll be able to listen to the recording afterwards as well. Any questions? Anything you're not sure about? Anything you want me to explain again at this point? It might sound a little bit foreign at this stage, but once you've gone over it and practiced a couple of questions yourself, hopefully it will become clearer. Anything you want me to, as long as you followed the logic of what I'm explaining to you for now, have you followed the logic? Are you okay? You can just give me a thumbs up or a smiley face or a yes or a no in the chat box. I'll tell you what I'll do quickly. Okay, perfect. So that was basically part 1 of what we've got to do. First step is we've got to calculate our NOPAT according to our rules in those bullet points on page 6. So we've done that. We've got our NOPAT. And guys, it doesn't matter if you've made in a question like this, if you make a mistake with it, as long as you can see here where all of these different marks come from. There will be marks for workings. Please put your workings down. Make sure to get those marks. And there's a method mark for the answer. So as long as you know what format this table calculating NOPAT must look like, that's what your memorization job is. What does my calculation for NOPAT look like? What must be added, what must be subtracted in arriving at that figure? You will definitely get most of the marks. So then they had said to us in our question, we've got 525,000 rands worth of equity, so that's only part of our invested capital. And they have told us that our economic value added was calculated, so we know what the answer to the EVA equals NOPAT minus blah, blah, what that formula is. EVA equals 233,950. So we're going to have to calculate that part of the capital, the invested capital in brackets. That's the amount that we're going to have to calculate. Okay, so let's go and see, put the information that we have got into our formula. So this is the memo that came with this question. I have just made some additions to the bottom to break it down in a clearer step-by-step format for you. So because it was with these work-ins here that they gave for the memo, they'd be difficult for you to follow on your own without an explanation. So always start out by writing your formula down, and this little formula is on the formula sheet. EVA equals NOPAT minus invested capital times WACC. But just remember, for your test one, just trying to remember, for test one, I think the only formula, no, you do get, sorry, I don't want to lie to you. The formula sheet that you will get in semester one for test one, so I'm just checking, I'll double check, but I'm not sure. No, it does not contain the EVA formula. I thought it did. I'm not sure of that. Sorry, guys, just give me a sec while I double check. Oh, okay. I think I'm thinking of the free cash flow formula. All right, so your EVA formula is not on your formula sheet, so you do have to memorize this formula. Okay, so I'll just put that in the chat box. Oopsie. Must memorize the EVA formula. Sorry, guys, I'm calling it a test. You guys are distance students, so it's your task one. For your task one. I can't remember if they attach, I think they do attach a formula sheet to your tasks as well. Okay. But basically these days your tasks operate very similar to a test because you've only got one day in which to complete them. So you need to learn, you need to prepare for task day as if it was a closed book test day so that you know you would be completely ready for it. Okay, so write your formula down, EVA equals NOPAT, so because you want to, there, okay, write our formula down. And what I've done here on the side is just summarize the information that was given to us. We have now calculated our NOPAT here. So we know that NOPAT equals 295,200, and this is where we got that answer. We know EVA equals 233,950. That was given to us in the scenario. So invested capital times WACC equals, we've got a question mark there, that is the amount that we have to calculate. So we write your formula down, EVA, there's our one variable, equals, NOPAT, there's our second variable, and then in brackets, we've got the third amount, invested capital times WACC. Then we fill in what we do know. So EVA 233,950 equals NOPAT 295,200 minus, and at this point that is still unknown. So if I now put the 233,950 and the 295,200 on the same side of the equal sign, I get 295,200 minus 233,950 equals invested capital times WACC. So 295 minus 233,950 equals 61,250. So I know that when I do the calculation, invested capital times the WACC, which again they was given to us, times 8.75%, the answer is 61,250. So now I know what the answer must be. don't know the invested capital Rand value, but I do know it's got to be multiplied by 8.75. So now in this little part of the this little calculation, I've only got one unknown variable, which is invested capital. So it's just like doing algebra. So we want to solve for RC. So if we take 61,250 divided by 8.75%, that gives us 700,000. So then we know that invested capital equals 700,000. And in our information over here, part of our invested capital is made up of equity, which is 525,000. And the rest of invested capital is interest-bearing bank loans. So now that we've worked out that total invested capital is 700,000, we subtract from that the equity portion, and what's left, the 175,000, is then going to be the Rand value of our interest-bearing bank loans. So this is then a demonstration of how we can use our EVA calculation to solve for the Rand value of our interest-bearing bank loans. They could have given us a scenario like this and then say, what is the equity Rand value? Or they could have given us this calculation and given us equity and interest-bearing bank loans, in other words, given us the total Rand value of invested capital and not given us the WACC. But any one of those variables that was left out or was the missing question mark, we can solve for as long as we have got all of the other variables. Okay, guys, so this is a fairly simple EVA calculation. In this one, we didn't have to do any complicated calculations of our invested capital. So your example 1.1 in your textbooks is very important for how to calculate NOPAT when over at least 2 years, and how to calculate invested capital according to those rules that we've got on page 6 and 7, also over at least 2 years. So I've used a simple example in our class tonight just to demonstrate the formula and how it works. But you must read through that section and do example 1.1, because there are some other steps that you need to know how to do that we didn't cover this evening. Okay, guys, we've come to the end of our time. Any questions at this point? Okay, it's a pleasure. I hope this was helpful. I always try and keep the online classes as simple as possible, so it helps you to give you a good jump start in your revision and in your working through the textbook. So please always just and then give me a shout if there's anything else that you need help with. Okay. And anything that you haven't understood, just send me a message on Learn, send me an email. I think I put my email in last week's chat. I'll just put it here again at re.ac.za. You can just use the message on Learn. There's it says contact your lecturer. You can use that, or you can email me and just ask for some help if there's anything that you're not 100% sure of. Okay, guys, I'm going to close off the recording.